Good morning to all. This is Professor Srinivasan from the Department of Commerce. Today we shall see the subject of income tax and its basics. Okay, do you know that does the agricultural income in India is taxable? Okay, otherwise, does the income earned by Virat Kohli in Australia for playing World Cup cricket is taxable in India? Or any income earned by Maxwell for playing IPL in India, will it be taxable in India or Australia? We shall see the answers with this class. The objective of today's class is to understand the basics of income tax, residential status and incidence of tax. Okay, before moving to the concept of income tax, let's see the history of income tax. Do you know that income tax has been introduced in 2000 years ago? Say for example, Caesar Augustus have charged the tax at the beginning of the world. Further, tax has been levied in Greece, Germany, Roman empires. In 1188, England levied tax on movable property, that is land. Even the Manusmriti supported the king could levy the tax. Further, with regard to income tax in India, in 300 BC, Mauryan Empire had charged the taxes for landlords and charged the salt tax, toll gates and import tax for goods imported from Sri Lanka and China. And 1860, Sir James Wilson introduced income tax in India to meet the losses due to the military mutiny of 1857. The old Income Tax Act was replaced with the Income Tax Act 1918. After independence in 1961, Indian government have introduced the Income Tax Act 1961, which came into effect from 1st April 1962, which has been amended in each and every year. Amendment means the changes in the act. The rules were changes made by the Ministry of Finance in each and every year by passing the bill in Parliament. We have two categories of taxes. One is direct tax, another one is indirect tax. Further, taxes can be levied by central government, state government and both the governments. Some of the major central taxes are income tax, corporate tax, customs duty, general CST and integrated GST. The state government can levy state GST and stamp duty. Okay, why do we need to levy the tax? Government levies the taxes to provide the basic facilities for every citizens of country and to finance multiple government schemes and to protect the life of government as well as the life of people and life of the country. The key personnel in income tax is Finance Minister, Minister of State Finance, Revenue Secretary and Chairperson of CBDT. CBDT is a Central Board of Direct Tax, which is the apex body to frame the rules and regulations with regard to income tax in India. Our Finance Minister is Nirmala Sitharaman. She will introduce the bills in Parliament and changes the tax rules in each and every year. Okay, now we shall learn the meaning of income tax. What do you mean by income tax? Okay, first, what is tax? Yeah, tax is amount paid by every person to the government compulsorily as per the law. Then what do you mean by income? Anything that we have received or earned will be called as income. It can be in the form of cash or kind. So what do you mean by income tax? It is a tax on income. Further, we can define that income tax as the tax which is charged by central government on the total income earned by assessee during the previous year. Further, income tax will be computed during the assessment year. Here the key points are: income tax can be levied only by central government, not by the state government. And tax will be charged on the assessee. Then, tax will be calculated on the total income, not on the each and every single income. Further, income tax will be computed or charged or assessed during the assessment year for the income earned in previous year. If you want to understand the meaning of income tax, first of all, you should understand four key important terms, that is previous year, assessment year, person and assessee. We shall recollect the meaning of person, previous year, assessee and assessment year during this session. Previous year, it has been defined under section 3 of Income Tax Act that previous year means it is a year preceding the relevant assessment year. What it means? It is a year previous to the current year. What is our current year? 2022-23. Then previous year will be 21-23. Then why we should learn the concept of previous year? Here the key thing is any income earned during the previous year alone will be chargeable for the assessment during the current assessment year. So previous year means it is a year in which income has been earned by the assessee. For us, the previous year starts from 1st April of every year and ends with 31st March of next year. Currently, our previous year is 2021 and 22. The date is, it starts from 1st April of 2021 and ends with 31st March of 22. The important thing is any income earned by the person starts from 1st April 21 to 31st March 22 alone will be taxable during the assessment year 22-23. Then we shall move to assessment year. It is defined under section 2 subsection 9. Assessment year means it is a current financial year and it is the year in which income will be computed and tax will be charged by the central government. For us, the assessment year is 2022-23. The date is 1st April 2022 to 31st March 2023. Okay. Could you differentiate previous year from assessment year? Yes, we can. Previous year means it is a year in which income will be earned, whereas assessment year, it is a year in which tax will be calculated and income will be calculated. For us, the previous year is 2021-22 and assessment year is 22-23. Thank you. Then we shall move to the next concept, person. Why should we learn about the person? Okay, do you know that only tax will be charged only for the individual, only for the person? No, tax will be charged for the person who will be defined under section 2 subsection 27. The term person includes individual, that means you and me, human being. Then HUF, Hindu undivided family, they also have to pay the tax. Then person, the term person includes firm, AOP, BOI, company, local authority, every other artificial judicial person. What it mean? We knew that individual means human being, you and me. Then HUF, Hindu undivided family, that means a joint family which runs a business, which earns income that will be taxable in the name of HUF. Then who is responsible for HUF? The Karta will be the responsible person for the income of HUF. The next category is firm. What do you mean by firm? Firm means partnership firm which is registered under the Partnership Act. Then what do you mean by firm? The firm is joining of 2 or more persons to run a business to earn a profit as per the partnership deed which has been registered under the Partnership Act will be called as firm. Then apart from the firm, association of person is liable to pay the tax, then body of individual is liable to pay tax, company is liable to pay tax, then local authority is liable to pay tax, then every other artificial judicial person like university, Thiruvallur University, Sacred College, they are also liable to pay the tax under the Income Tax Act. So the term person includes 8 categories: individual, HUF, firm, association of person, body of individual, company, local authority, and every other artificial judicial person. All these 8 category of people, persons are liable under the Income Tax Act, whether they are paying tax or not, but they are covered under the Income Tax Act. Then the next definition is assessee. Who is assessee? Say for example, who is student? A person who is registered to study a course is a student. Similarly, a person having an ID card is a student. Likewise, who is assessee? Assessee is the person one who earns the income and pay the tax. One who earns the income and pay the tax as per the Income Tax Act. Say for example, you could have watched the film Teri. In that film, a baby called Nainika has acted in that film. She might have earned income, say for example 10 lakh. For the 10 lakh, who is liable to pay the tax? Is it the Nainika or a parent? A Nainika is a minor child. For her parent is Meena, actress Meena. She has to pay the tax for the income of Nainika. Then in this case, Meena will be called as deemed assessee. So the term assessee includes assessee, that means a person who is liable to pay tax under this Income Tax Act, and deemed assessee and assessee in default. Okay. Now we shall recollect the basics of income tax. Income tax is the tax it will be charged on the total income. Income must be earned during the previous year and tax will be calculated during the assessment year. Who is covered under the Income Tax Act? All the 8 category of people: individual, firm, AOP, BOI, company, local authority, every other artificial judicial person, etc. etc. And who is assessee? A person who is liable to pay tax will be called as assessee. Now we can probably say that we knew the basics of income tax. Let's shall move to the concept of agricultural income, because at the beginning of the class itself I have told that should we pay income tax for the agricultural income? To give the answer, we should know the basics of agricultural income under section 2 subsection 1A under the Income Tax Act. What do you mean by agricultural income? The Act says that any rent or revenue received from agricultural land situated in India is an agricultural income. Any income from agricultural operation will be called as agricultural income. Income from sale of agricultural product is an agricultural income, and income from farmers is an agricultural income. Rent or revenue. Assume that I have a land of 1 acre. I am giving my land to Mr. Sasi for an agricultural purpose. Assume that he has paid rupees 10,000 for a year for that agricultural activities. Then that 10,000 will be called as agricultural income. Suppose I have cultivated a banana in my land. I have sold that banana for rupees 1 lakh. That will be called as agricultural income. Similarly, the byproduct of a banana tree is a banana leaf. If I sold it for rupees 1,000, that will be called as agricultural income. So the term agricultural income includes rent or revenue, income from agricultural operation, income from sale of agricultural product, and income from farmers. Here, what is the rule for agricultural income under the Income Tax Act? Agricultural income earned in India is totally exempted, whereas agricultural income earned in foreign country will be taxable. You knew that. You knew that. Does all the people doing agriculture are paying the tax or not? No, they are not paying the tax. Cases has not been filed on them. The reason why? It is exempted under section 2 subsection 1A. Otherwise, each and every farmers should pay the income tax. This is the option provided by the Indian government for the farmers. The term agriculture includes another concept called partly agricultural income. Say for example, I have 10 acres of land in Ooty. I am cultivating tea leaf. Further, I have a factory in that Ooty itself. From that factory, I have earned 1 crore as a profit. Does it agricultural income or business income? It has two parts. First part is I have cultivated tea leaf in my land. I have produced the tea in my factory, so it has agricultural operation as well as business operation. Here the 1 crore will be divided into two categories. 60% will be agricultural income and remaining 40% will be business income. For that 60% there is no tax, remaining 40% I have to pay the tax. Say for example, for that 1 crore, 60% is 60 lakh. Out of 1 crore, 60 lakh is exempted since it is a partly agricultural income. Remaining 40 lakh will be taxable as a business income. This is case for income from growing and manufacturing of tea. Suppose I have grown and manufactured coffee. What will be the rule? 65% of income is agricultural income and exempted. Remaining 35% is business income and that will be taxable. And suppose I have cultivated and manufactured latex, that is rubber. In such a case, 75% of income is exempted and remaining 25% is business income. We shall summarize it here. For tea, 60-40. For coffee, 65-35. For latex, 75-25. Okay. Then, the another part of agricultural income is non-agricultural income. Say for example, I have a shop in Ulavar Sandai, that is a regulated market. I have a shop in Ulavar Sandai. I am selling brinjal for rupees 10,000. Is it agricultural income or business income? Suppose from my well, I am supplying water to my neighbor. They have paid ₹1,000 for my water. Will it be taxable? Will it be agricultural income or business income? So, for example, another example, I have cultivated, sorry, I have not cultivated. Assume that for the case of the film Pushpa, he has cutted the trees in a forest and sold it for crores. Will it be agricultural income or business income? Will it be taxable or exempted? Another example, suppose in my land, I have made bricks and sold it for 10,000. Will it be agricultural income or business income? The answer will be all these items are non-agricultural income, though it is directly or indirectly relevant to the land or farm activities, but it is non-agricultural income. The reason is, the simplest reason is, it is not cultivated by the assessee, it is not cultivated by me. Hence, it will be treated as non-agricultural income and further it will be taxable. Say for example, income from market, income from dairy farm, poultry farm, income from fisheries, income from stone quarries, income from mining royalties, income from land used for brick making, supply of water for irrigation purpose, self-grown grass, trees and bamboos. These are all the items are non-agricultural income and it will be taxable as a non-agricultural income in India. I have given that example for the film of Pushpa. It is a self-grown trees. The hero doesn't cultivated or doesn't grow the trees. So it is a non-agricultural income, hence it will be taxable. Okay, we can summarize the concept of agricultural income. Any income earned from agricultural operation in India will be called as agricultural income. If it is earned in India, it is exempted. If it is earned in foreign, it will be taxable. Yes. The third concept of today's session is residential status. Till this time, we have recollected the basics of income tax and the basics of agricultural income. Now we shall move to residential status. I have given a case at the beginning of the class that Virat Kohli's income in Australia for World Cup matches, will it be taxable in India or Australia? Or Maxwell's income or A.D. Villiers' income in India for IPL matches, will it be taxable in India or the respective countries? What will be the answer? The answer depends on the residential status. Where they have bond is immaterial, whether they are resident or not is a material or important thing for the income tax purpose. So the total income and tax liability of assessee is determined on the basis of residential status of assessee during the previous year. Before moving that, we have two concepts. One is citizenship, one is residential status. Since Virat Kohli has bond in India, should he pay all the income? Should he pay tax for all the income that has been received in India or foreign? No, it is not depends on the citizenship, rather it is depends on the residential status. What is the difference between citizenship and residential status? Here, the citizenship is determined based on the place of birth, whereas residential status is determined based on the number of stays a person stayed in a particular country. Then second thing, mostly citizenship won't change in each and every year, whereas residential status could change from year to year. Similarly, a citizen of one country may not be a citizen of another country, whereas a resident of one country can be a resident of another country. At last, income tax and taxation is not depends on citizenship, rather it is depends on the residential status. Here we have three types of status. One is ordinary resident, second one is not ordinary resident, third is non-resident. In short, OR, NOR and NR. What it mean? For simplest example, a person who is staying in India regularly, almost in every year, will be called as ordinary resident. A person who mostly stayed in foreign country will be called as non-resident. Okay, here a person, whether it is OR or NOR, NR, will be determined based on the certain conditions. We shall recollect the conditions for individual. Section 6, subsection 1. An individual, that means you and me, could be an ordinary resident, could be a not ordinary resident, could be a non-resident. Before that, why we should learn the concept of OR, NOR, NR, that is residential status? The reason is tax will be decided based on their status, whether OR or NOR and NR. So first we should know whether a person is ordinary resident or not ordinary resident or non-resident. Here, in case of you and me, residential status will be determined based on the two conditions. One is basic condition and another one is additional conditions. Say for example, this is me. Okay, if I stayed in India for more than 182 days during the previous year, I have satisfied the basic condition. Here we have options in basic condition. First option is a person, an individual must be stayed in India for at least minimum of 182 days during the previous year, that is 2021-22. Otherwise, I have another choice. If I stayed in India for at least 60 days during the previous year. Further, I should stay at least minimum of 365 days during the last 4 years, that is 2017-18, 18-19, 19-20, 20-21. Here the rule says that during the previous year 21-22, I should stay at least 182 days. If not, I should stay at least 60 days. Plus, during the last 4 previous years, preceding the current previous year, I must stay in total, in aggregate, 365 days. The last 4 years is 17-18, 18-19, 19-20 and 20-21. So, in basic condition, we have option. Option A, 182 days in 2021-22. Option B, 60 days in 2021-22 plus 365 days in last 4 years. If a person fulfilled any one of the basic condition, then further go and check whether he has satisfied the additional conditions. What are the additional conditions? Condition number 1, he must be stayed in India for at least 730 days during the 7 years preceding the relevant previous year. What it mean? The last 7 years, that is 2013-14, 14-15, 15-16, 16-17, 17-18, 18-19, 19-20, 20-21. For the last 7 years, I must be stayed here for at least 730 days. In aggregate, I must be stayed for 730 days. So last 7 years is 2021, 1920, 1819, 1718, 1617, 1516 and 1415. Out of this last 7 years, I have to be here in India, anywhere in India for at least 730 days. If I fulfill the first additional condition, he has to satisfy the second additional condition. That is, he must be a resident in India for at least 2 out of any last 10 years preceding the relevant previous year. What it mean resident? For the last 10 years, it starts from 11-12, 12-13, 13-14, 14-15, 15-16, 16-17, 17-18, 18-19, 19-20, 20-21. Out of this last 10 years, I must be in India for 182 days, at least for any 2 years. At least 2 times I have to be here for a minimum of 182 days. Then I will be called as resident. Here, we have gone through the basic condition and additional condition. In basic condition, we have the option 182 days or 60 days plus 365 days. In additional condition, all the 2 conditions are compulsory. One is, first additional is 730 days in last 7 years and 2 out of last 10 years I must be a resident. If I satisfied any one of the basic condition and additional condition, I will be called as ordinary resident. I will be called as ordinary resident. What will be happen if I am an ordinary resident? I have to pay for the taxes that I have been earned in India as well as foreign will be taxable in India. I should pay the tax to the government for the Indian income as well as foreign income. We knew that most of the time Virat Kohli stays in India alone. Assume that he fulfilled one basic condition and two additional conditions. In such a case, you should pay the taxes for the income earned in India as well as earned in Australia to the Indian government. Indian income as well as foreign income, you should pay tax to the Indian government compulsorily. If not, income tax cases will be charged on Virat Kohli. I hope you knew the concept of OR. Then, when an individual can be not ordinary resident. Suppose assume that Virat Kohli fulfilled any one of the basic condition but failed to satisfy in additional condition, then he will be called as not ordinary resident, at last non-resident. If I fail to fulfill the basic condition, I will be called as non-resident. Non-resident. Okay. Say for example, Maxwell or A.D. Villiers or any one of the foreign players, they are coming to India for the IPL matches alone for the period of maximum of 60 days or 70 days. In such a case, can they satisfy any one of the basic condition? No, there is no chance. Then they could be called as non-resident. If they are the non-resident, they have to pay the taxes for the income earned in India alone. Let me give an example. Suppose A.D. Villiers plays IPL matches in India and received 10 lakh, just for 10 lakh. Similarly, he has earned income of rupees 10 crore in South Africa. Here, for the 10 lakh is a non-resident that has been earned in India. For the 10 lakh alone, he should pay the taxes to the Indian government. For the South Africa's income, he has to pay the taxes in South Africa alone. What is the reason? A.D. Villiers or whoever it may be, they are the non-resident. So, non-resident should pay the taxes for Indian income and not for the foreign income. Okay. Residential status of individual, section 6, subsection 1, we shall recollect or summarize the thing. Individual can be ordinary resident when he fulfilled any one of the basic condition and both the additional condition. If they satisfied one of the basic condition and fail to satisfy the additional condition, they will be called as not ordinary resident. If they fail to satisfy in basic condition itself, they will be called as non-resident. Okay, this is for individual. What about the TVS company? Have they have any rules? What about the Adani companies? Say for example, Adani companies earns income in India as well as for Australia for the mines. Similarly, for Apple company, they are earning income in America as well as India. For which income they have to pay the taxes to the Indian government. Here we have the rule of the same rule: ordinary resident, not ordinary resident, and non-resident. For company, section 6 subsection 3 defines that a company is an ordinary resident when it is registered in India and control and management fully situated in India, then it will be called as ordinary resident. Then it won't be not ordinary resident for the non-resident. For the non-resident, if a company registered in foreign country or control and management fully or partly in foreign, then it will be called as non-resident. What will happen? Say for example, TVS company, where it is registered, assume that it is registered in India, the entire control and management is in India, then it will be ordinary resident. If it is ordinary resident, TVS company should pay the income earned in India as well as foreign income. They should pay the taxes to the Indian government. Apple company, will they are OR or NR? They will be non-resident because it is a foreign company. Control and management is not fully in India, so it is a non-resident. If they are non-resident, they should pay the taxes for the Indian income alone, not for the foreign income. Okay. What about the residential status of HUF? Section 6 subsection 2 says that HUF will be ordinary resident when the Karta, that is head of the family head, maybe a father or grandfather, whoever it may be, the Karta must fulfill any one of the basic condition and both the additional conditions. Further, they have an additional condition that the control and management fully or partly must be situated in India. Then it will be called as OR. For HF, they have three conditions. One is basic condition, second one is additional condition, then third is control condition. In basic condition, Karta must fulfill any one of the basic condition. For additional condition, he should fulfill both the additional conditions. For control rule, control and management fully or partly must be situated in India. Then it will be called as ordinary resident. Suppose Karta failed to satisfy the additional condition, it will be called as non-resident. Suppose Karta failed to satisfy the basic condition itself, then HUF will be called as non-resident. For every other persons, firm, AOP, BOI and every other persons. Say for example, Sacred Heart College. Assume that Sacred Heart College has a branch in USA. Should they pay taxes to the Indian government or foreign USA government? For the cases also, it will be decided based on the residential status. That is OR, NOR and NR. Ordinary resident, if our college's control management is fully or partly situated in India, then the college will be called as ordinary resident. If it is ordinary resident, they should pay the taxes for the Indian income as well as foreign income to the Indian government. If the control management is fully situated in foreign, then it will be called as non-resident. For the non-resident, Indian income alone will be taxable to the Indian government. This is the concept of residential status. Okay, once again, we shall summarize the concept of residential status. We should learn the concept of residential status because tax is charged based on the residential status. We have three types of status. One is ordinary resident, second one is not ordinary resident, and third is non-resident. In short, non-resident should pay the taxes for Indian income alone, whereas ordinary resident should pay the taxes for Indian income as well as foreign income. Then how will be determined? OR, NOR and NR. For individual, they should satisfy any one of the basic condition and both the additional condition, then it will be OR, ordinary resident. If I fail to satisfy in additional condition, then I will be not ordinary resident. If I fail to satisfy the basic condition, I will be non-resident. That's it, the most simplest thing. Let me give one case. Could you find the answer here? Okay. Neymar. He is from Brazil. He is playing football matches in Qatar, the World Cup 2020-22. Assume that Neymar earned income for the matches playing in Brazil for 10 crores. And for the matches in Qatar, for the World Cup matches, he has earned 2 crore. Here, should Neymar pay the taxes to the Brazil government or Qatar government? What will be the answer? Could you give the direct answer? No, you should not give the direct answer. You should check whether he is an ordinary resident or not ordinary resident or non-resident. Then only you can finalize the taxation rule. Have we got the thing? If he is an ordinary resident, he should pay the taxes for the entire income. If he is non-resident, he should pay the taxes for the home country's income alone. Now we have finalized. In case of myself, I am the ordinary resident. Since most of the days I am living in India, I never went to foreign country. From the day of birth, I will be called as ordinary resident. Is it okay? Then if I am ordinary resident, which are the income will be taxable to me? And which are the income will be taxable to non-resident? Which are the income will be taxable to not ordinary resident? That concept will be called as scope of income or incidence of tax. Incidence of tax. Say for example, let me give the cases. Could you find the answers? Suppose assume that I have earned an agricultural income in Sri Lanka 10,000. Will it be taxable? Again, suppose I am playing a cricket matches in New Zealand. I am earning rupees 2 lakh. Will it be taxable? Suppose I am running a business in France, earning 10 crore. Will it be taxable? All this concept will be determined under the head scope of income or incidence of tax. For this chapter, we could form a 4 rules category. We could learn the concept with the rules, 4 rules. Rule number 1. This is the shortest method for this chapter. Rule number 1. Rule number 1 is not taxable to all. That means past income, earlier year income, share of profit from firm, gift from relative and marriage, all the 4 items will be covered under rule number 1. Let me repeat it. Rule 1 includes past income, earlier year income, share of profit from firm, then gift from marriage or relative. All these 4 items will be not taxable to all the cases. Whether I am OR, whether I am NOR, whether I am NR, that is immaterial. It will not be taxable for all the cases. Suppose, assume that I have received 1 lakh as a gift on my marriage. Will it be taxable? No, it is not taxable because it comes under the rule 1. So rule 1 says that any past year income, any earlier year income, share of profit from firm, then gift from relative and marriage, that will not be taxable in all the cases, whether OR, NOR, NR, that is immaterial. What do you mean by past income? Suppose assume that I have earned rupees 5 lakh in 2013-14. In 2013-14, I have earned rupees 5 lakh. Will it be taxable right now for this assessment year? The answer is it is taxable, but not for this assessment year. It will be taxable for the assessment year of 2014 and 15, not during this assessment year. So it is not taxable for this year. Then, what about the share of profit from firm? Why it is not taxable? The reason is, suppose assume that Mr. Srini, Mr. Sasi, Mr. Vijay, all these 3 persons have formed a business and run a business. The firm earned, the business earned rupees 10 lakh as a profit. Assume that for the firm's profit, we have paid rupees 1 lakh as a tax. What is the remaining balance profit? 9 lakh. That 9 lakh will be distributed equally to Mr. Srini, Mr. Vijay and Mr. Sasi. 3 lakh each, 3 lakh each and 3 lakh each. Here, should Sasi pay tax for the 3 lakh again? No, it is not. There is no need to pay the taxes again because that income is already paid as a tax. Already tax has been levied for that income. Firm has paid the rupees 1 lakh as a tax for the total income. So here there is no need to pay the further tax. Let me give another example. Suppose assume that my dad earned rupees 5 lakh as income and he had paid 50,000 tax. Out of remaining 4 lakh 50,000 income, he has given 2 lakh to me. Should I pay tax again for the 2 lakh? There is no need. The entire income has been charged with my dad's income. So it is not taxable. What about the gift? The shortest rule for gift is any gift received on marriage is totally exempted. Similarly, any gift received from relative is also totally exempted. You could have watched a lot of things in a marriage. Most of the people have given in the name of dowry or gift or moi. In Tamil it will be called as moi. Will it be taxable? No. Have they paid taxes for the moi income, gift income? No, they haven't paid the taxes. What is the reason? It is totally exempted. Whoever it may be, whether ordinary resident, not ordinary resident or non-resident. What could have been happened if there is no rule? All the married people will be in jail because not paying the tax. Have you got the point? Yes. So any gift received on marriage is totally exempted. Similarly, any gift received from relative is also totally exempted, whether OR, NOR and NR. Am I clear? We shall move to second rule. Second rule is related with agricultural income. For an agricultural income, if you have to check only where the land is there or where the income has been earned or where the cultivation has been done. Check where the land is there. If it is in India, that is totally exempted. If it is in foreign, it will be taxable to OR. Let me repeat it. For an agricultural income, you have to cross check where the cultivation has been done, where the land is there. If it is in India, that is exempted to all. If it is in foreign, taxable to OR. Let me give cases. Income from agriculture in Tirupattur rupees 10,000. Will it be taxable? No, because agricultural income in India is exempted to all. Second case, income from agriculture in Pakistan, rupees 20,000. What will be the answer? It comes under rule number 2. The agriculture has been done in foreign, so it will be taxable only to OR. You have to post that 20,000 to OR. For NOR, NR, it is not taxable. Rule number 3. Rule number 3 is related with income from business. Income from business. It has 3A, 3B and 3C rule. In case of business income, you have to cross check where the business is there, where the business is situated. If the business in India, it will be taxable to all the cases. Income from business in India is fully taxable to OR, to NOR and NR. Okay. Let me give an example. Income from business in Chennai, rupees 30,000. What will be the answer? It comes under rule 3A. Rule 3 is business. A, the reason for A is it is in India. Chennai is in India, so the answer is taxable to OR, NOR and NR. Am I clear? Okay, what will be happen? Suppose if the business in foreign, suppose assume that I run a business in Singapore and I have earned rupees 2 lakh. Will it be taxable? It depends on the rule number 3. So rule 3A is if the business in India, taxable to all. Suppose if the business in foreign, you have to cross check where the control and management is situated. If the foreign business controlled from India, the amount will be taxable to OR and NOR, not to NR. It will not be taxable to NR. Let me repeat it. Income from business in foreign, controlled from India, will be taxable to OR and NOR alone. Suppose the business is also foreign, control is also in foreign, then what will be the answer? It will be taxable only to OR. OR alone will be taxable. For NOR and NR, it is not taxable. What is OR? Ordinary resident, not ordinary resident, non-resident. The shortest word is OR, NOR and NR. Okay, let me summarize the rule number 3. Rule number 3 for business income, you have to check where the business is there. If the business in India, it is taxable to all. If the business in foreign, cross check where is the control. If the control is in India, it will be taxable to OR and NR. If the business in foreign and control is also in foreign, it will be taxable to OR alone. Shall I give the cases? Yeah. Income from business in France, controlled from Japan, rupees 10,000. What will be the answer? You have to cross check the answer. Will it comes under rule number 1, 2 or 3? It is not rule number 1 because it is not a past income or gift income. So it is not rule number 1. It will not come under the rule number 2. What is the reason? For rule number 2 is for agricultural income. It is not an agriculture. So it comes under the concept of rule 3. Where the business? It is in France. Where it has been controlled? It is in foreign. So foreign business controlled from foreign. So rule 3C taxable to OR alone. Am I clear? Okay. Suppose if the business in Italy controlled from Chennai, what will be the answer? The foreign business, if the foreign business controlled from India, then it could be taxable to OR and NOR alone. You should not post the amount for NR. Suppose I have a business in Calcutta. Earned rupees 50,000. So business answer will be the business in India, so taxable to all the cases. Let me give one trick, one further example. I am running a business in Mumbai. It is controlled from London. What will be the answer? Answer is it comes under rule 3A, taxable to all the cases. Why? If the business in India do not cross check all other category, all other rules, all other points, all other explanation, If the business in India, it will be taxable to all the cases where the control is there, where it has been received, where he has spent the amount, what he did, that is immaterial, that is irrelevant. If the business in India, it is taxable to all the cases. If it is foreign, cross check where is the control. If it is in India, taxable to OR and NOR. If it is in foreign alone, it is taxable to OR alone. Am I clear? The rule number 4. It is for all other income. It is for all other income. What it mean? If any income does not falls under rule number 1, rule number 2, rule number 3, that will be assessed under rule number 4. What is rule number 1? Rule number 1 is related with past income, earlier income, share of profit and gift. What is the answer? Not taxable to all. Rule number 2 is agricultural income. If it is in India, exempted to all. If it is foreign, taxable to OR. Rule number 3 is with regard to business. Business in India, taxable to all the category. Business in foreign and control from India, taxable to OR and NOR. Business in foreign and control from foreign, taxable to OR. Other than 3 cases, any income other than 3 item will be assessable under rule number 4, all other income. Let me give one example. I have received salary from Sacred Heart College, rupees 50,000. Will it falls under rule number 1? No. Is it agricultural income? So it is not rule number 2. Is it business income? No, it is not, comes under rule number 3. Then where it has been assessed? It will becomes under rule number 4. Am I clear? Okay, what is the answer? Before moving to the answer, let me give another cases. Assume that I have a building in London. I have lettered my building to Rishi Sunak. Just for example, I have lettered my building to Rishi Sunak. I have received rupees 1 lakh as a rental income. Will it be assessable under rule number 1, 2, 3 or 4? The answer is 4 because it is an all other income. It is not an past year income, it is not an agricultural income, it is not an business income. So it has to be assessed under all other income category. Am I clear? Then suppose I have deposited rupees 1 crore in State Bank. I have earned rupees 10 lakh as an interest. Where it will be assessable? Rule 1 or rule 2 or rule 3 or rule 4? Obviously it will be assessed under rule 4 only. Yes. So what is the rule 4? So rule 4 is related with all other income other than 1, 2 and 3. What is the answer? If all other income earned or received in India, it will be taxable to all the cases. Either it must be earned in India or it must be received in India, it will be taxable to all the cases. Then suppose if it is earned and received that in foreign, that is full and full foreign, it will be taxable only to OR. So either it must be earned in India or received in India. If any one of thing has been done in India, then it will be taxable to OR, NOR and NR, all the cases. If the entire thing has been done in foreign, it will be taxable only to OR alone. Okay, earlier I have given an example. I have received rupees 50,000 salary for the work in Sacred Heart College, Tirupattur. It comes under rule number 4. Is it Indian income or foreign income? It is an Indian income. What is the reason? I worked here. The income has been earned in Sacred Heart College. Where I have received? It is received in Sacred Heart College. That is in India. So hence it will be taxable to OR, NOR and NR. That 50,000 will be taxable if I am OR, if I am NOR and if I am NR. Am I clear? Then what about that rental income from house property in London? Where the building is situated, where the income has been earned, it has been earned in London. Where I have received? I have received in London itself. Then it will be taxable only to OR. Am I clear? Suppose assume that I have worked in Sacred Heart College, Tirupattur, but I received the salary in Japan. After working during the month of November, I went to Japan and settled there itself and received the salary from our college. So work has been done in India. but received in Japan. Will it be taxable to all or taxable to OR? The answer is taxable to all. What is the reason? It comes under rule number 4. What the rule number 4 says that if it is earned in India or received in India, taxable to all. Taxable to all. So here I have earned in India alone. So any one of the places has been in India, then the obvious answer is taxable to all the category. Am I clear? Am I clear? Yes. Here we have the special rule. We have the special rule. What is the rule? Apart from all these 4 rules, we have one extra rule. The extra rule will be applicable only for business income and all other income. Let me repeat that. The extra rule will be applicable only for business income and all other income. What is the rule says that? For business income and all other income, if any amount or any portion of the amount is received in India, then it will be taxable to the untaxed person, untaxed cases. What it means, sir? Let me give one example. Income from business in Italy, rupees 10,000. Where it will be taxable? It is full and full foreign, so taxable to OR under rule 3C. Out of this 10,000, assume that out of this 10,000, 1/4 has been received in Chennai. What will be the answer? For that 1/4, that is 2,500. 10,000 multiplied by 1/4, 2,500 will be taxable to untaxed person. Here I have not entered the amount to NOR and NR. So I have to post the amount 2,500 to NOR and NR. Have you got the point? This will be called as extra rule. This will be called as extra rule. Is it okay? Yeah. Suppose, let me give another example. Another example. I have sold my house at Canada for rupees 1 crore. So house is in Canada, so it is full and full foreign. So rule number 4, taxable only to OR. I have posted 1 crore to OR. Assume that out of 1 crore, I have received 20 lakh in Chennai. What will be the answer? That 20 lakh will be taxable to untaxed cases. I have not posted the amount to NOR and NR. So I have to post that 20 lakh to NOR and NR. This rule is called as special rule. Am I clear? So this is called as scope of income or incidence of tax. So scope of income or incidence of tax can be summarized, can be learned, could be understood with 4 rules. Rule number 1, past income, earlier year income, share of profit from firm, gift from relative or marriage is not taxable to all the cases. Rule number 2, agricultural income, if it is in India, exempted to all. If it is in foreign, taxable to OR. Rule number 3, business income. For business income, if the business is in India, taxable to all the cases. If the business in foreign, controlled from India, taxable to OR and NOR. Suppose if the business in foreign and control is also in foreign, it is taxable to OR. Then rule number 4, any income that is not covered under 1, 2 and 3 should be treated as all other income. For all other income, either the amount must be earned in India or received in India, then it will be taxable to all the cases. Suppose if it is earned in foreign and received also in foreign, full and full foreign income, it will be taxable only to OR. Further, the extra rule for the business income and all other income, if any amount is received in India, that received amount should be posted to the cases where the amount is not given, where the amount is not entered. Okay. We shall see a problem based on the concept of incidence of tax. Point number 1. Salary drawn for a work in London office of Indian company, rupees 10,000. What will be the answer? Salary drawn for the work in London office of Indian company. So we have to cross check whether it is comes under rule 1, 2 or 3 or 4. Salary, it is not a past income, so not rule number 1. It is not an agricultural income, it is not a business income, so obviously it is rule number 4. Where he has worked in London. For whom? For an Indian company. From where he will receive the salary? He will receive the salary from Indian company. So obviously one item is in India, so it is taxable to OR, NOR and NR. 10,000, 10,000, 10,000. Then point number 2. Profit from business in USA controlled from France 20,000. Could you tell which rule it will be applicable? Yes, rule 3. Where the business is there? It is in USA. Control France. So business in foreign, control is also in foreign. Full and full foreign. If the in case of business, if it is fully foreign, taxable to OR alone. Enter 20,000 for ordinary resident, for NOR and NR dash and dash. Then point number 3. Past untaxed foreign income brought into India during the previous year. Here what it means? He has earned the income in earlier year, past year. It could be in 2015-16 or 17-18 or 2000 in 1947 or 2001 or 2. The past year's income he has brought it to India during the previous year. So the income is not taxable for this current year. Rule 1, we have applied the rule 1. Then so not taxable to OR, NOR and NR. We shall move to point number 4. Income from house property located at Iraq but received in Chennai. What will be the rule? Rule 4, because it is an all other income. Where the house property is there? It is in Iraq but received in Chennai. So if any income earned in India or received in India, then it will be taxable to all the cases. So we have applied rule 4A, that is he has received in India, so taxable to all. OR 40,000, NOR 40,000 and NR 40,000. Then point number 5. A dividend from Indian company received in Chennai. The rule is rule 4, because it is an all other income. What is the rule 4 says that if it is earned in India or received in India, taxable to all. If not, taxable to OR. In this case, dividend from Indian company, so earned in India, so taxable to all the cases, 50,000 each to OR, NOR and NR. And point number 6. The point number 6 is income from business in Japan, controlled from Chennai. Rule 3B, because foreign business controlled from India, so taxable to OR and NOR. 60,000 to OR and 60,000 to NOR. Here the problem further says that out of 60,000, 1/4 of the amount was received in Chennai. For 60,000, 1/4 is 15,000, 15,000. That 15,000 should be posted for NR, because for NR we haven't entered that amount. So we have applied rule 3 as well as the extra rule. Point number 7. Salary received from Indian government for the work at England. Salary received from Indian government for the work at England. Obviously rule 4. From where he has received? He has received the amount from Indian government. So it is an Indian income. If it is an Indian income, taxable to all the cases. 70,000, 70,000 and 70,000. And point number 8. Agricultural income from India. Agricultural income from India. Rule number 2. Agricultural income. It is in India. So answer is exempted to all the cases. Directly you could write exempted to OR, NOR and NR. Then point number 9. Income from business in Chennai. Income from business in Chennai. So rule number 3A, because it business. Rule 3 for business. Chennai is in India. So rule 3A, for rule 3A taxable to all the cases. If it is an Indian business, the answer is taxable to all the cases. Do not cross check anything. Then point number 10. salary received in USA for the services rendered in India. Here he worked in India but received the salary in USA. The answer is Rule 4A, taxable to all the cases, because any one of the item is in India. Either it must be earned in India or received in India. Here it is earned in India, so taxable to all the cases. The total income will be for OR 4,40,000, for NOR 4,20,000, and for NR 3,75,000. Okay. Could you check the answer here for another problem? Interest on German development bond 51,000. Answer Rule 4. Interest is an all other income. It is a German development bond, full and full foreign, so taxable to OR 51,000 for NR dash and NOR dash. The sum further says that 1/3 of the amount is received in India. For that 1/3 we have to apply the special rule, because anything received in India, that has to be posted for the untaxed person. For 51,000, 1/3 is 17,000. So 17,000 should be posted to NOR and NR. What will be the final answer? OR 51,000, NOR 17,000, and NR 17,000. NR 17,000. Then point number 2, income from agriculture in Bangladesh remitted to India. Here do not cross check about where he spent, what he did, does he remitted, does he deposited. Do not cross check where the income earned or where he received. You check, that's enough. Income from agriculture, we have to apply rule number 2. Agriculture in Bangladesh, so foreign agriculture taxable to OR alone. Point number 3, income from property in Canada received in USA. Income from property in Canada received in USA. Full and full foreign income, Rule 4, so taxable to OR. That's simplest answer. And point number 4, income from business in Kuwait controlled from Mumbai. So rule number 3B, business, foreign business controlled from India, 3B. Answer is taxable to OR and NOR. 65,000 to OR, another 65,000 to NOR. For NR dash. But the sum further says that out of 65,000, 25,000 was received in India. So that 25,000 should be posted to NR, because the NR is an untaxed person. Then we shall move to point number 5, dividend from foreign company 10,000. Which rule we have to apply? We have to apply rule number 4, all other income. What is the rule says that if it is India, taxable to all; if it is foreign, taxable to OR. So dividend has been earned from foreign company. It is not an Indian company. It is not received in India, so it is taxable to OR alone. Point number 6, royalty received in Singapore from Mr. David, a resident in India, for technical services provided for a business carried in Singapore. Okay, let me give one example, one case. You could have watched film Yaradi Ni Mogini. In that film, Dhanush and Nayanthara went to Australia for a project for 1 month. Here the case is, for that 1 month, they could have earned rupees 1 lakh as a salary from the Indian company for the work done in Australia, isn't it? Will it be taxable to OR, NOR and NR? What will be the answer? Yes. Again you have to check 1, 2, 3, 4 rule. It comes under rule number 4, because salary income. Though they have worked in Australia, but they have received the salary from Indian company, from India. It is an Indian money. It is an Indian income. If it is an Indian income, taxable to all the cases. Taxable to all the cases. Same logic here, we can apply it here. So 25,000 will be taxable to all all the cases, OR, NOR and NR. Okay, let me have an interesting point. Profit from business in Chennai but control from Singapore. What will be the answer? Rule 3, business. Business in India because Chennai. What is the answer? Taxable to OR, NOR and NR. So OR 1,25,000, NOR 1,25,000 and NR 1,25,000. Here what about this point? Controlled from Singapore. That is not needed. That is irrelevant data because the rule 3 says that if the business in India do not cross check anything, post that amount to all the cases. If it is in foreign alone, cross check where the control is there. Am I clear? If it is foreign business, then only you have to cross check where the business there. Is it okay? Here in this point, where the business is there, it is situated in India. So the obvious answer is taxable to all. Yes. Point number 8. Profit on sale of building in India but received in Nepal. What the point says that Assassi has a building in India. Assassi has the building in India. He sold that building for a profit of 2,50,000, but he received that amount in Nepal. Nepal is a foreign country. Is it okay? What will be the answer? Again, you have to cross check 1, 2, 3, 4 rule. This will be applicable. Rule number 4. Rule number 4 says that if it is earned in India or received in India, either one must be in India, then taxable to all. Here, where he has sold the building, in India, so income has been earned in India. If it is earned in India, taxable to all the cases. So OR 2,50,000, NOR 2,50,000 and NR 2,50,000. Okay. The next point. Income from agriculture in Punjab received in Mumbai. Which rule you could apply? Rule number 2 for agricultural income. What you have to cross check? Where the agriculture has been done. If the agriculture is done in India, taxable to all the cases. If it is done in foreign, taxable to OR. Isn't it? Here where agriculture has been done, it is done in Punjab. Punjab is in India. So what will be the answer? It is exempted to all the 3 cases. That's it. The next point. Profit from business in Indonesia. Profit from business in Indonesia controlled from Delhi. Controlled from Delhi. Could you give the rule? Is it 1? No. Is it rule 2? No, because it is not an agricultural income. Rule 3? Yes, because it is a business income. What is the rule says that for business income, if it is in India, taxable to all. If it is in foreign, check where the control is there. Here, where the business is there, it is in Indonesia. It is in foreign business, but it has been controlled from Delhi. So, in case of foreign business controlled from India, it could be taxable to OR and NOR. So, OR 40,000 and NOR 40,000. For NR, dash. Nothing has to be posted for NR. Then point number 11. Interest received from Mr. Dayal, a non-resident, on the loan provided to him for a business in India. It is an Indian income because he has done a business in India, so it is taxable to OR, NOR and NR. At last, the final answer will be the gross total income of OR is 7,35,000, NOR 5,25,000 and NR 4,45,000. Am I clear with the concept of scope of income or incidence of tax? Shall we summarize the concept of scope of income or incidence of tax? Yes. It is about taxability of income. Income will be taxable based on the residential status and not based on the citizenship. We have learned that in earlier classes. Okay. Here we have 3 types of residential status. One is ordinary resident, second is not ordinary resident, third is non-resident. How we have to calculate the taxable income? You should calculate based on 4 rules. Rule 1, 2, 3, 4. Rule 1 says that past income, earlier year income, share of profit from firm and gift from relative or marriage totally exempted, totally not taxable to all the three cases. For all the three cases, it is not taxable. Rule number 2 is for agricultural income. What you have to cross check? Where the agriculture has been done. If it is done in India, exempted to all. Suppose if it is done in foreign, taxable to OR. Do not cross check anything for an agricultural income. Where it is received, where he deposited, where he spent, no, nothing. Check where the agriculture has been done. If it is in India, taxable to all. If it is in foreign, taxable to OR. Am I clear? Am I clear? Then rule number 3 is for business. What is the rule? What do you have to cross check? Where the business is there. If the business in India, taxable to OR, NOR and NR. If it is in foreign, cross check where it has been controlled. From where it has been controlled. If it is controlled from India, taxable to OR and NOR. If the foreign business is controlled from India, controlled from foreign alone, then it will be taxable to OR. Is that okay? For rule number 4, last rule, rule number 4, what will be the answer? Any income which doesn't fall under the rule of 1, rule of 2 and rule of 3 should be treated as all other income. For all other income, you should cross check whether it is earned in India or received in India. If any one of the thing has been done in India, then it will be taxable to all the cases OR, NOR and NR. Thank you. Suppose if both has been in foreign, then it will be taxable only to OR. Only to OR. Am I clear? Then with regard to extra rule, in case of business income and all other income, if any amount is received in India, post that amount to the category where you haven't entered that amount. Am I clear? That's it. We have learned the concept of residential status and scope of income and basics of income tax. Do you have any doubt? Now we can probably say that I knew at least the basic concepts of income tax, because we have learned about the meaning of income tax, history of income tax, then basic definitions, then agricultural income, then scope of income, then residential status. The one most important thing, income tax will be charged for the total income earned by the assessee during the previous, not on the each and every income. Suppose assume that today I have earned rupees 10,000. Should I pay tax for today's income? Not like that. For the income earned in previous year, that is 21-22, the total income of 21-22 will be assessable, will be taxable during the assessment year 22-23. Here you could have a doubt. What is income? What is income? We haven't learned the meaning of income, but we gone through the residential status, scope of income, etc., etc., etc. What is income? Section 2, subsection 24 of Income Tax Act doesn't define what is income. Let me repeat it. It doesn't define what is income, but it has said that the term income includes income from salary, income from house property, income from business and profession, capital gain and all other income. So, Income Tax Act has classified income into 5 category. One is 5 heads. One is income from salary, income from house property, income from business and profession, capital gain and other source. The total of all the 5 heads of income will be called as gross total income. From that gross total income, we could deduct certain amount under section 80C to 80U. Let me repeat it. From the gross total income, we could deduct certain amount of expenses or deposit or certain amount as per section 80C to 80U. The balance income will be called as total income. So we could give a definition for gross total income and total income. What is the gross total income? Gross total income is a total of 5/8 of income before making any deductions. Then what is the total income? Total income means it is a total of 5/8 of income after allowing deductions under section 80C to 80U. The final amount will be called as total income or taxable income. Suppose, let me give an example. Assume that my annual salary income is 5 lakh computed amount. So income from salary is 5 lakh. I have not have any income from house property, business and profession, capital gain and other source. My gross total income is 5 lakh plus 0 plus 0 plus 0 plus 0. So total is 5 lakh. From that 5 lakh, suppose I have deductions under section 80C to 80U, say for example 1 lakh. I have deducted 1 lakh. What is the balance amount? The balance amount is 4 lakh. This 4 lakh will be called as total income or taxable income. Here my taxable income is 4 lakh. Out of this 4 lakh alone only, my tax will be calculated. I have to pay the tax. Have you got the point? So tax will be determined based on the total income, not on the individual income. Is it okay? Then again, what is income? There is no definition of income, but we have the features of income. Here the term income can be cash or kind. So for example, for my November month work, I have received 50,000 from Sacred Heart College as a cash. That is also income. Suppose for that 50,000, assume that father doesn't pay 50,000 in my account, but he has given a laptop worth rupees 50,000. Srini sir, you could take rupees 50,000 worth of laptop for your November month salary. Will it be my income or not? It is also income. So income can be earned in the form of cash or in the form of kind. Then point number 2, income must be received from outside. Income must be received from outside. What it mean? Assume that I have 10,000 in my pant packet. I have taken the 10,000 and kept in a shirt packet 10,000. Will it be my income? No, it is not my income because it is not received from outside. I have taken from my own packet. Okay, let me give one cases. Assume that your dad has given rupees 100 when you comes to the college. Will it be your income? Or your dad has given rupees 200 to your mother for the vegetable expenses. Will it be the mother's income? No. Both are not an income because it is the income of your parent, not the income of you and not the income of your mother. Am I clear? Yes. So what is the reason? Income must be received from outside. And point number 3. Rule number 3 is, point number 3, income, there must be definite source of income. There must be definite source of income. Suppose assume that after completing this session, I am going to my native place by bike. While going to my house, I found a bag in the road. It has 50 lakh. It has 50 lakh. Bag has 50 lakh. I have taken that amount. And at the end of the year, I said that I have 50 lakh of income during this year to the income tax authorities. What they will do? They will ask from where you have received that 50 lakh. Do you have any answer? There is no answer. There is no answer. I couldn't say that I have taken from the road. What I have to do? If I taken from my road, I should hand it over to the government. I should hand it over to the treasury, or I should hand it over to the police personnel, because that is not my income. Is it okay? So if anything should be treated as income, there must be definite source. If not, it is not your income. So we have seen 3 points. One is there must be definite source of income. Point number 2 is it must be received from outside. Then point number 3, income may be money, cash or kind. And point number 4, pin money and packet money is not an income. That means the cases that I given, that your father has given 100 rupees for your daily expenses. That is a pocket money. That is not an income. And good. Suppose assume that I have given 1000 rupees to you. So that is no 1000 rupees. Suppose assume that I told you to recharge my mobile for 700 rupees. You have done the recharge for me. After that recharge, I have given rupees 700 to you for that amount. Will it be your income? Have you earned rupees 700? No, you haven't earned income. It will be called as reimbursement of expenses. Reimbursement of expenses is not an income. That is an expenses amount. You have made that expenses. That is not your income. There is no need to pay in tax for that 700 rupees. Am I clear? So, reimbursement of expenses is not an income. PIN money is not an income. Packet money is not an income. At the end, we could summarize that income must be cash or kind, received from outside, and there must be a definite source of income. Is it okay? Okay. With this thing, we have learned the basics of income tax. We could summarize that income tax is the tax of total income earned by SSE during the previous year. What do you mean by previous year? The year in which income has been earned. What do you mean by assessment year? Assessment year, the year in which income will be computed and tax will be charged. For us, the previous year is 21-22, assessment year is 22-23. Who is assessee? A person who is liable to pay tax will be called as an assessee. Okay. The next part is agricultural income. If it is from India, it is exempted to all. If it is from foreign, taxable to OR. Then further we have learned residential status. Tax will be charged based on the residential status of assessee. We have three types of status: OR, NOR and NR. For individual, it will be decided based on the basic condition and additional condition. Then for HUF, it will be decided based on the Karta's fulfillment with regard to basic condition and additional condition. Further, they have control rule. In case of company, the residential status will be decided based on the registration and control and management. Then for every other person, it will be decided based on the control. Then we have completed the concept of residential status. The next is scope of income. The scope of income or incidence of tax could be summarized, could be grouped in 4 category. Rule 4. Rule 1, not taxable to all. Rule 2, agricultural income, taxability based on the land. Then Rule 3, business income, taxability based on where it is situated. Rule 4, all other income, taxability based on where it has been earned or where it has been received. At last, total income means it's a total of 5 years of income after allowing deductions under section 80C to 80U. If the final amount, if the total income is more than 2,50,000, we have to pay the tax. If it is less than 2,50,000, there is no need to pay the tax. Yes, that's it. We have learned the basics of income tax. We could see in next session. Thank you. Have a nice day. God bless you. Sasi sir. Sasi sir. Sir. For 1 minute.